Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Monday everybody. Being the start of the week, today's video will be an economy-focused episode, and it's very fitting too, as today, Monday, the National Bureau of Statistics published China's official data for Q1 of this year, and the consensus largely is that even the official numbers are very disappointing. Let's start with the headline number. In Q2, China's GDP expanded 6.3% year-on-year, off the low base point of 2022 during zero COVID lockdowns, missing the 7.1% estimate. Raymond Young, chief economist at ANZ Banking Group for Greater China, commented on the numbers, quote, "The figure is even lower than our below census forecast. Apparently the impact of property slowdown is a massive drag," end quote. Indeed, China's economy grew slower than expected in the second quarter as retail sales growth slowed and the property market slump deepened, which we will discuss later. The National Bureau of Statistics official spokesperson, with the release of this disappointing data, put the reasons down to two factors, quote, "sluggish global growth and a lack of domestic demand," end quote. One Beijing-based economist observed that given distorted base effects, it may be more useful to consider quarter-on-quarter GDP growth. On that basis, second quarter GDP grew by 0.8%, half the average rate of the 5 years before COVID, down from 2.2% in Q1. This represents an annualized growth rate of 3.2%. Considering this is supposed to be a recovery year for China, this is shockingly slow growth. In a note to clients, Capital Economics wrote today, quote, "The data published today suggests that the reopening recovery has slowed to a crawl in Q2, even as it appears to have stabilized in June," end quote. The firm also downgraded its annual growth forecast to 5.5% from 6%. And once again, we remember this is coming off a low base year. Peking University finance professor Michael Pettis expressed today on the numbers, quote, "The composition of growth was as disappointing as the growth itself. Industrial output in June was up 4.4% year-on-year, or up 0.68% month-on-month. Retail sales, a proxy for consumption, were up 3.1% year-on-year, or up 0.23% month-on-month," end quote. The poor numbers, which can be added to recent data showing risks of deflation and rising joblessness, once again has prompted more speculation about the question of stimulus, a tool Beijing still appears unwilling to turn to in too large a degree out of fears of exacerbating the already super high debt level and related systemic financial risks. Quote, "We don't think today's data will push Beijing to step up stimulus measures. Beijing will introduce some supportive measures over the second half of the year, including additional fiscal transfers to local governments. However, these measures may not turn things around. Due to weak confidence, negative sentiment, and the huge fiscal cliff due to the collapse of land sales, we believe markets should curb their expectations for a fast, cure-all package and instead embrace expectations of a growth slowdown towards below 4% in 2024, end quote. Goldman Sachs predicts targeted measures, writing today, quote, "To counteract persistent growth headwinds, property slowdown and confidence deficit in particular, we expect more targeted easing measures in coming months with a focus on fiscal, housing and consumption," end quote. China-based CITIC securities analyst Liu Dezhong wrote on Weibo this afternoon that the lower-than-expected GDP, quote, "gives some optimism for more stimulus," end quote. However, Ding Shuang, chief China economist at Standard Chartered, observed today, quote, "With the target growth within reach, targeted and measured stimulus will be employed instead of a blanket strong stimulus," end quote. China's benchmark CSI 300 index of stocks was down 1.1% as of the midday break, the first decline in 3 sessions. The onshore yuan weakened 0.4% to 7.17 per dollar just after the noon break. Among the most alarming signals in the data was a steep contraction in property investment, much more severe than analysts had anticipated. Property development investment dropped 7.9% year-on-year in the first 6 months, down from a 7.2% decline. Quote, "Property is the key to resolving the various current problems. The most urgent support needed for property is to stabilize the supply side. Too many developers have been in trouble, and there can't be more large-scale defaults. Otherwise, housing development will come to a halt." End quote. And next up, we take a closer look at property. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's just me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation. Subscribing and sharing is a huge help as well, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. As we just explained, property development investment continued to plunge according to the latest data, a serious red flag for the economy generally and for the housing sector specifically. Unfortunately, other red flags have also appeared in recent days related to property, which we need to examine. Over the weekend, data from real estate service provider Savills showed that more than 18% of office spaces in Beijing were left vacant during the second quarter, up 1.5 percentage points from the previous quarter, and the most in nearly 13 years. During the second quarter, the net absorption volume for office spaces in Beijing was negative 135,000 square meters, meaning more tenants terminated leases than new tenants signed up. Chinese financial media outlet Caixin, reporting on the numbers, writes that the office rental market in major Chinese cities, including Beijing and Shenzhen, has, quote, remained sluggish this year after a post-pandemic recovery has been slower than expected. Many companies relocated or postponed new leasing plans during the pandemic, and they have remained cautious to step up expansion amid the slow business recovery. End quote. Meanwhile, on Saturday, the National Bureau of Statistics published the official data for new home prices. The official numbers showed that China's new home prices were unchanged in June, the weakest result this year, and down from May's 0.1% gain. 31 of the 70 cities monitored by the National Bureau of Statistics recorded month-on-month rises in new home prices, down from 46 in May. This once again demonstrates, based on Beijing's own official data, that the property sector remains very sick, with the many measures rolled out by the government having little to no effect at reviving the battered market. Quote, "We shouldn't be surprised that measure after measure to stabilize and revive the property market has failed. In a highly speculative market, what drives buying is mainly expectations of continued price appreciation. By this definition, China's property market has been highly speculative for well over a decade, with rental yields close to 1%. It was always smarter to rent a big apartment than buy a tiny one. But people kept buying because property prices can only rise. That means that the only way to stabilize or revive the property market requires reigniting the property bubble and setting off a new round of ever-rising expectations. Even if that were possible, it is something Beijing clearly doesn't want to do. In that case, the best thing the regulators can do is decide what a much smaller property market with much lower prices will look like, what the associated losses are that must be absorbed, and the best way to get there quickly. Of course, that's much easier said than done. There will be a lot of angry homeowners and huge conflicts over how the losses are to be distributed. But trying to revive the sector will only make things worse in the medium term. End quote. In a tweet the same day on the same subject, Professor Pettis added, quote, "It's hard to stabilize a deflating bubble." End quote. Let's end then with this observation by Goldman Sachs economists today, and believe it or not, this is considered the optimistic take. Quote, "We believe the policy priority is to manage the multi-year slowdown rather than to engineer an upcycle. As such, we only assume an L-shaped recovery in the property sector in coming years." End quote. Okay, that is today's economy-focused episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Monday, and I will see you all tomorrow.